Hey everyone, welcome back to the channel. Today, we're diving deep into a topic that's on every investor's mind. The massive AI boom and the big tech companies leading the charge. You see it everywhere. Names like Google, Microsoft, Nita, they're all pouring billions and billions of dollars into artificial intelligence. It feels like the next big revolution, the new internet, the new smartphone, and the market has certainly reacted that way. Stock prices have soared and the excitement is palpable. And this is a big, but there's something that's been making me feel a little uneasy lately. When you look past the headlines and the hype, you have to ask a crucial question. Where's the money? I mean, where's the actual tangible profit coming from all this investment? We hear about incredible new models and groundbreaking research, but the path from a cool demo to a $1 billion revenue stream isn't always clear. For many of these companies, the massive spending on AI hasn't translated into equally massive profits yet. It's still largely in the potential phase. And that feeling of uneasiness is something we need to manage as investors. In the world of finance, you can never be 100% certain about anything. We can't know for sure if this AI wave will crest and deliver on every promise, or if it might fall short of these incredibly high expectations. What we do know is that the growth we've seen in a very short time has been enormous. The run-up in stock prices has been nothing short of spectacular. This means that major investors, the big funds and institutions who got in early, are sitting on some very handsome profits. Now, what happens when people are sitting on huge profits? They have the option to take that money off the table at any moment. A single piece of bad news, a disappointing earnings report, or even just a shift in market sentiment could trigger a wave of profit taking. If that happens and you haven't prepared for it, the risk of getting caught in a downturn is significantly higher. Your chances of losing money go way up. That's why proactive risk management is not just a good idea. It's absolutely essential in a market like this. You can't just hope for the best. So, since no one can predict the future with complete certainty, what's the smart way to approach this? It all comes down to preparation. Think about it like this. You would never bet your entire life savings on a single lottery ticket, right? You know the odds are stacked against you. Investing has its own set of probabilities. Imagine a bell curve, that classic shape from statistics class. Most of the time, our investment outcomes will fall somewhere in the middle of that curve. We'll have some small wins, some small losses. That's the most probable scenario. It's the everyday reality of the market. But the bell curve also has tails, the extreme ends on the left and right. The left tail represents the small but real possibility of a huge loss, a market crash. The right tail, on the other hand, represents the small possibility of a massive, life-changing gain. The probability of these events happening is low, but their impact is enormous. Many investors get fixated on that right tail, dreaming of that one investment that will make them rich overnight. They chase the hype, hoping to catch the next big thing before it explodes. But the most successful investors understand the whole curve. They respect the high probability of being in the middle, but they also prepare for the low probability, high impact events at the tails. This is where the concept of having a war chest or a cash reserve comes in. You need to have a certain amount of capital set aside, ready to deploy. You don't just print more money when you need it. You have to have it ready beforehand. This cash serves two purposes. First, it's your defense. If the market takes a downturn, if that left tail event happens, your cash buffer protects you from having to sell your assets at the worst possible time. It gives you staying power. Second, and this is the exciting part, that cash is your offense. It's your opportunity fund. When others are panicking and selling, that's when prices get cheap. That's when incredible buying opportunities appear. Having cash on hand allows you to take advantage of that fear and buy great assets at a discount. This is how fortunes are often made. It's about being prepared to act when everyone else is frozen by fear. You turn a market crisis into your personal opportunity. This strategy reduces your overall risk while simultaneously increasing your potential for outsized returns. So, When we look at the current landscape with all its promise and all its froth, this is the mindset we need to adopt. It's fine to be optimistic about the future of technology. I certainly am. AI is going to change our world in incredible ways. But as an investor, your job isn't just to be a cheerleader. It's to be a strategist. Recognize that the growth has been huge and that a correction is always possible. Understand that the big players can cash out at any time. Therefore, you must have a plan. Don't go all in. Keep some powder dry. Have that cash reserve ready. This way, you're prepared for whatever the market throws at you. If the AI boom continues to the moon, great. Your existing investments will do well. But if there's a pullback, you won't just survive it, you'll be in a position to thrive. You'll be the one buying when others are selling, setting yourself up for the next wave of growth. That's how you navigate an uncertain market with confidence. It's not about timing the market perfectly, but about being prepared for all its seasons. Thanks so much for watching today. I hope this gives you a useful framework for thinking about your own investments in this exciting but tricky market. If you found this helpful, please hit that like button and consider subscribing for more content like this. Let me know your thoughts on the AI boom in the comments below. See you in the next video.